Let's talk about the US debt spiral now. This is, although a story in the background that has been on for a long period of time, I think it is coming to a point where you will not be able to sort of. So let's start from the warning that Ray Dalio is making. Ray Dalio, of course, is a world famous wealth manager, institutional wealth manager, and he says that US is entering a death spiral of debt. So what studies that have been done by Ray Dalio and others is that every fiat currency goes through this cycle at some point or the other. Nothing can really last forever. So whether it was the Roman Empire or the Spanish Empire after that, or the British Empire after that, every empire as well as every cycle, every currency essentially keeps getting to a point. The debt is raised to a point where it can't sustain itself, and the question is that is the US now at that point or near that? So Ray Dalio had warned a couple of weeks back, and just a few weeks later, Moody has also cut US credit rating. So now all three credit rating agencies have cut US bonds to below AAA rating. And there are now, I think, 11 or 12 countries which are higher rated than US in terms of paper quality. So the most powerful economy in the world, but it is not getting recognition as the sort of safe haven in terms of people holding its bonds is a matter of concern. The concern here is that the debt is reaching unsustainable levels. So US is at $37 trillion or something like that, which is on the books, and there are off-book debt as well, or basically commitments that need to be paid, and it's getting to the point where it is impossible to pay this debt. So just like, you know, a country is not very different from, let's say, an individual. If we see the comparative example, that I have a income of 1 lakh rupees, which is equivalent to the taxes collected by the country, and I'm making expenses of, 1,50,000, and I'm borrowing it right now because my credit rating with my friends and family is very good, right? So people are giving me money because they know at some point I will pay them back. Then my debt continues to rise, and it has risen to this level where even my brother is not willing to lend me money because he knows that I can never pay it back. So that is the situation where the US debt is reaching, where its own allies are, not so comfortable uh, putting money into US debt. So there are only two ways where classically, historically also, how to deal with very high debt is either to keep refinancing it. So, you issued a bond for 30 years or 10 years or 20 years, and once that bond limit came, you refinanced it for the next so on so much period. Or you create so much inflation in the economy that the amount that you have to pay becomes very small 30 years hence, 20 years hence, or whatever is that. So all this basically is, the creditors also are watching this, and it breaks trust. So right now, for instance, the bond ETF, the most popular bond ETF, TLT, has not made money in a decade now. So all these people who are sitting with 60-40 kind of portfolios, 60% equity, 40% debt, the 40% is not working for them because the interest rates that have been coming down for 40 years, for the last 5 years now they are going up, and hence bond values are going down. I'll come to that in a bit. So let's first also define, what is the US debt spiral. So basically, countries are dumping US debt. When countries dump US debt, they are basically sellers of US debt. So who is going to buy US debt is the question. The demand for US treasuries or US debt falls basically, and to lure more people to buy their debt. Why does US need to issue debt? Because they have all these expenses to cover for. So they need money from somewhere, and they are going to issue bonds. Who is going to be the buyer of the bond? So basically, you try to lure others to buy your bonds. That, okay, I'll pay you 30 years later. Give me the money right now. So you offer higher yields, right? But when buyers see that, that your debt spiral is actually going out of hand, then even higher yields don't attract them anymore. Higher yields actually for yourself become higher interest payments, and your collection of tax is only so much. So if most of that money that you're collecting as a country starts to go towards interest payments, how you will take care of your own? economy, right? Government has a lot of expenses, defense, public service, so on and so forth. So the debt servicing of the government starts to become more and more expensive, and it crowds out other expenditure that the government wants to do. And hence there is a budget crisis, complete budget crisis, because what you're earning is nothing compared to what you're spending, and there is no way to reverse it easily, because if you start to reverse it, there is going to be civil riots, because you're taking entitlement of people away who got used to it. So interest payments then start to eat most of the budget. Just like in an individual case also, if you keep maxing out your credit cards, at some point of time that interest is going to become meaningful in your complete earnings. So now to plug this gap, the US has the ability to print more money, which the individual does not, but the US has that potential. Okay, let's print more money. Now printing causes inflation in the economy, and more dollars are chasing the same goods. And when inflation happens, interest rates have to rise to sort of curtail the inflation, and bond values collapse. So bondholders again get jacked. So investors continue to demand higher and higher yields to compensate for this risk, and then it becomes like a feedback loop where something has to collapse, something has to crash, some war has to happen where somebody has to default in a big way for the story to start again. So top holders of US debt, for instance, China and Japan. This is pink line is that of China, and you can see that from year 2000 till 2011, perhaps, they were building their reserve of US dollars, US treasuries. But then they realized that we need to get out of dollars, US treasuries, and they have almost halved their current holdings. Uh, Japan also has, since the last 10 years, not allowed the US Treasury holdings to go up. There is only one country, UK, which of late has been picking up US Treasuries, and that could be a backdoor entry of, of some entities. And the others are gradually going up, Belgium, Canada, and so on and so forth. So, but the larger chunks are Japan and China. And Japan itself is dealing with a lot of yield problem right now. Japanese yield has gone to 3.5%. They've not seen this kind of yield in the last 20 years. So now what happens in Japan is basically a yen carry trade happens, where people borrow in yen and invest overseas. Now, if the carry cost becomes very high, all those trades will reverse. So there is going to be liquidity crisis also now coming out of those international investments. And Japanese people themselves will say that, let's invest in our own bonds at 3.5%. Why we need to go out? So a lot of dynamics is involved because of the bond market. And bond market is actually the biggest elephant in the room. We typically never talk about it. We give so much importance to equity, but bond markets is the real deal actually. And recently, when Trump was trying to pressurize a lot of countries, it was the bond yield which crossed 5%, where he had to step back and say, okay, I'll relook or give you 90 days more, or we'll climb back from the 130, 150% position. So bond yields can really, it's like that tail which can wag the dog, and nobody can really stand up to it. So this is sort of the chart of the US 30-year yield, and this chart is a 40-year chart, where yields were continuously coming down from the 80s till COVID time. And from there, it is just one way move up. From nearly zero, we've gone to nearly 5% on US 30 years. Now imagine that a huge amount of debt which the government currently has, how they're going to roll it over. So $9 trillion of US debt needs to be rolled over. So old bonds will mature and you have to issue new bonds. Issuance of new bond has to happen at the current yield, otherwise the buyer will not come. In fact, it will have to be even, they will try to entice the buyers to come and buy $9 trillion worth of. And if there are no foreign buyers, then you will have to print money and buy it yourself. So everything in both ways, you'll have to bear the interest rates which are very very high, versus you may have earlier financed it at 1% or 2%. Now you have having to pay 5% on it, and the Fed has been tightening. So this $9 trillion, this chart is telling you the market interest bearing public debt maturing within 1 year uh, is a very large amount, $9 trillion for this maturity. And now Treasury Secretary Besant is saying that GDP has to grow faster than debt. and that's the way out of this. He's absolutely right. GDP has to grow faster than debt, but how to make GDP grow faster than debt? Because the debt is going very, very fast. So if we see the last 5, 10, 15, 20 years charts, GDP is not able to keep pace with debt. I mean, this yellow line is the debt increase, and the red line is GDP. Whether it is 20 years, last 20 years, whether it is last 15 years, whether it is last 10 years, let's last 5 years, debt is going at a scorching pace versus GDP. So only solution left is to offer higher and higher yields to buyers of these debt, which is going to collapse the system. Or the other option is to let the Fed print a lot of money. That is going to cause an unbeatable inflation. So the Fed and the US government is stuck, and they have been, kicking this can down the road since almost a decade. But now perhaps it is coming to a point where you can't ignore it for too long. And the deficit also every year basis, which used to be 500 billion, 600 billion, in now suddenly 2 to 3 trillion every year is the deficit. They're trying Doge and every other things, but it doesn't seem to be working too much. The On the asset side, they have reduced, by doing QT, but now the market is becoming too tight, and they will have to release and do QE once again to balance this market. And whenever that happens, emerging markets, precious metals, all those markets will do well, because there'll be flood of liquidity again to tide over this situation. So as US debt becomes more and more unattractive, countries may stop seeing USD as a safe reserve. So what was also happening was this. If I give you the example of the petrodollar cycle, so US in the 1970s told, like, Saudi Arabia, that you are going to price oil only in dollars. So anybody buying oil from you, you need to price it in dollars. So Saudi Arabia was getting dollars out of their oil sales, and that dollar was coming to US as an investment. So it was like recycling, that was happening. Now, if Saudi Arabia deals with China, they deal in local currencies. So there is no USD involved right there. So this demand for the dollar is collapsing in from that point of view. And hence, anything which is a antidote to the dollar, which is essentially assets like gold, Bitcoin, perhaps, or even emerging markets, they are likely to see some sort of a divergence from where they are. Also, Trump's tariffs are going to be importing a lot of inflation. So, even if tariffs are there, ultimately the consumer has to pay the price, and that is going to cause a lot of inflation for the US market. So, while there is no real answer, how we will get out of this debt spiral, but it's a very interesting economic problem to understand and see what kind of solution can come out of it. And I again go back to the individual example, that when a person who is trapped in debt, you maxed out all your credit cards, everything is maxed out, and your interest payment cycle is going up, what will you do? You will have to declare bankruptcy, or something has to default. And that is the fear that the market has, that either we will go to a situation where, nobody is wanting to buy US paper, or to avoid this situation, some big war will be unleashed on the world, and there a lot of defaults may happen, and a lot of restructuring and rebuilding and regrowth will happen, and this possibly can be set back by another decade or 5 years or something like that. So this is a very real problem. We can close our eyes and say that, this problem does not exist, but it does exist, and you have to protect yourself by investing in assets which will last this transition period. Let's say in the next 10 years, from US dominated world, we go to a multipolar world where China has also good domination, US also has some part, and other countries also have some part. So this transition that will happen is going to impact a lot of assets and asset classes. That is something that we need to take care of. So currencies like the US are losing purchasing power, and more and more money is going to get created, which will erode the value of the fiat. And gold, of course, is historically seen as a hedge against currency debasement and inflation. So anytime when we had transition, whether going from Spanish to British, or British to US, it was gold which was used as a transition medium to go from one to the other. And this is the reason that China is accumulating gold like nobody's business. In fact, they are giving discount to their retailers, to their citizens. 10% discount is available in Shanghai today. if you want to buy gold. So the government is subsidizing the purchase of gold so that more and more people are able to secure themselves. And essentially, we need to also do a balanced, diversified approach. Spread your equity exposure across geographies and themes. Don't bet on a single economy. So the biggest risk is that all our assets are in rupee, for instance. What if the rupee goes for a toss? That should not come as a surprise to anybody, if and when that happens. So you have to diversify. Some of your assets need to be in some other global currency. Some equity exposure may have to be beyond India. Some other assets may have to be taken on where there's a global exposure. So everybody is cutting US debt, increasing their gold reserves, and it is not just a strategy; it's risk management at the national level. Even the RBI is continuously increasing its holding of gold. It's gone from 6% of forex reserves to 12% of forex reserve in gold. So this debt crisis is real. It will not hit us till it hits us, but the smart ones will prepare for it. Thank you so much. Bye.